Hello, dividend growth stock investors. It's Colby, the DGI Crab. Happy Super Bowl Sunday to you. This is the video that up until now I used to do every Friday at the close of the market, but moving forward, going to go into each of the four tiers. That's right, the 60 stocks that this channel focuses on. I'm going to go through each of the four tiers, break them down, see where the values in the stock market lie. If you're new to the channel, my entire philosophy as a dividend growth stock investor revolves around age and time horizon, the most important metric, in my opinion, for a dividend growth stock investor to take into consideration. So happy to have you here. Really happy to get this series going on a Sunday now moving forward so you can take a look at it, make a plan for the week. Going into the week, you can know kind of what's on sale and what you might be trying to hone in on for your purchases this week. So since it's Super Bowl Sunday and I am a dyed-in-the-wool Chiefs fan, and not a fair weather Chiefs fan, I've been following this team closely since the 1995 season. So I am not a Johnny-come-lately to this team with Patrick Mahomes and all the success that they have had. You know, something that I've heard a lot about this Chiefs team, the word that gets thrown around about them this year is inevitable. That the Chiefs just feel like they are inevitable this year. And there's certainly Chiefs fatigue, understandably, for a lot of folks out there who would probably like to see another team representing the AFC in the Super Bowl at some point in time. But I was thinking about it, and I thought very similar to the Chiefs, or any great sports franchise that goes on a dynastic run like this, dividend investing is also inevitable. You know, the Chiefs this season, those of you that don't follow football, one of the knocks on them has been that they don't have any major blowout wins. Most of their wins are very close. They are not doing anything particularly sexy or exciting. They're just finding a way to eke out wins week in and week out. And that sounds a lot like dividend investing to me. You know, we're not looking to hit the home run. We're not looking to get rich by Tuesday, as my friend Ari Gutman says. But what we are trying to do is be consistent, make more correct moves than not. And at the end of the day, at the end of your trading career, the inevitability for you won't be a Super Bowl ring. It will be plenty of passive dividend income, ever growing, that you can live off of in retirement and get out of the rat race. All right, everybody. So I will say I'm not a legal professional financial advisor. Content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own, and you should always perform your own due diligence before investing any of your hard-earned money. And just really quickly, if you are new, this is how I invest. If you are not new, if you could feel free to skip ahead, but I do invest as follows. I put 50% of my money each week into age-appropriate ETFs. And with the other half of that money, I'm looking for stocks that are yielding 30% or more above their 4-year average yield. That's how I'm trying to get a bargain on the dividend income I'm acquiring. Now, I have a list of my top 10 favorite stocks that are just my personal preference, and if they're yielding just 20% or more above their 4-year average yield, I'll go ahead and buy them and prioritize them because I want to make sure that I have good, solid positions in all 10 of these companies. Now, I remain within my tier unless there's a stock in a different tier yielding 50% or more above their 4-year average yield. And at that point, I just feel like the bargain looks to be too good. And I'm going to try to load up on that position while I can so I can get the growth of the recovery, assuming that it does eventually happen. And then if there's no viable stocks within my tier in a given week, I don't invest less. I just take the money that I was going to invest for that week and I put it into ETFs. So I'm not trying to time the market with the ETFs whatsoever. I am trying to do that with the individual single stocks. And what we're going to do now, as you may know, is we're going to go into the spreadsheet here and look at each of the four tiers. So what do I mean by that? I'm talking about the age range of the investor. Tier 1 is the 18 to 30-year-old investor who have a lot of time to let dividend reinvestment and dividend raises compound and snowball. So these investors shouldn't be focused on high yield. We're talking about 1 to 1.5% starting yield typically on these kind of purchases. But you're looking for a cumulative dividend growth rate on these stocks to be comfortably above 10%. So you could get big time raises and enjoy those over the long haul. Now, I have them sorted by the valuation metric, and this is just taking that 4-year average yield compared to the current day yield to figure out how undervalued it looks like. This is a fairly similar metric to something that you would see like on Simply Safe Dividends. And if we've got stuff in the green, it's hit that 30% or more undervalued metric. And I don't sell things that look like they are overpriced, like my Broadcom position, for instance. I'm a buy and hold investor. The only way I'm going to sell off a stock is if it does a dividend cut. And then at that point, I'll jump ship and reallocate the capital somewhere else. But I don't expect dividend cuts out of any of my 60 stocks. Not saying it'll never happen, but I did select them very carefully because I didn't anticipate any cuts coming from any of these blue chip companies. Now, in this tier, we've got both Nike and Nordson, not only in the buy zone, but they're in that 50% or more undervalued range. So these could be open to purchasing for any of the age tiers. Now, I know the starting yield won't be super high for some of the older investors out there, but if you already have a fair amount of dividend income coming in to the point where maybe you can retire off of it, or you're already retired, but you're still sort of adding a little bit to stuff here and there, and you want to add some growth plays, you could certainly take a look at that as well. But certainly anyone under the age of like 45, I would think should be pretty excited to acquire Nike and Nordson at the current yields that they have. Nike just keeps dropping, which is certainly a concern. They kind of got downgraded by analysts. They're absolutely going through a tough time. This has been the most undervalued stock in the tier 1 category in the entire history of this channel. I've been adding a little bit to Nike every single week for, six-ish months now. So I built up a pretty nice position here. Like I said, if there's not a recovery story, if there's a dividend cut that comes, then I'll cut my losses and move on. But, Nike has been at this dividend increase thing for more than 20 years. Even through the tough times, they did an 8.6% dividend increase last year. So I'm going to stick it out with Nike. But to be honest, I might be even more excited about Nordson, which has been in the buy zone for a little while now. Dividend king, really excellent history of high dividend increases. And you can get that yield at 1.46%. You got to be pretty excited about this if you're a younger investor. All right, everybody, tier 2, age 31 to 41. Starting yield here is going to be a little higher. You're looking at like 2 to 3% starting yield with a dividend growth rate in the high single digits. So not quite as fast dividend growth, but a little higher starting yield. It kind of balances out that way. Hershey has been the one that I have been really aggressively adding for the past 3 or 4 months right now. It just has not been able to recover back up into that $200 range yet, but I think that Hershey will turn it around here eventually. I'm so excited that I've been able to build up this large Hershey position. If you guys have been buying Hershey as well and you're starting to feel nervous or impatient, I just say hang in there and just enjoy building up this position because, up until the middle part of last year, Hershey was pretty chronically an overvalued stock for quite a while. So they're just going through it right now. Cocoa prices are expensive and eventually they won't be. And Hershey is going to be an overvalued stock again at some point in time. And I'm going to be excited about that because, man, my portfolio is going to go way up when that happens at this point. Also, Target and American States Water, a couple of dividend kings with more than 50 years of annual dividend increases, still in that buy zone. Very happy to add American States Water right now. It's very under the radar, very boring, super duper consistent though. And then NextEra Energy and McCormick, close but not quite, but definitely keeping a close eye on them to see if they drop any further. NextEra just kind of needs to get down into like that 67.50 range for me, and I'll be happy to start adding back to that one as well. Tier 3, age 42 to 53-year-old investors, you're looking at starting yield range more in the 3 to 4% at this stage. We're going to start getting a little bit higher starting yield. You get up into your 40s. Still want to get dividend increases in the mid to high single digits, so you're still getting the annual increases in income. But man, this group, we've got 4 in the buy zone. Archer Daniels Midland, Hormel, Pepsi, Genuine Parts Company. Pepsi, one of my top 10 favorite stocks, has been a priority add here for me as well. I just need them to be 20% undervalued. They're 34% undervalued, so I am all about adding Pepsi right now. ADM and Hormel have just been down in the dumps for months now. ADM did a dividend increase recently. It was just a 2% increase, which was a lot less than that 11%er that they gave us in 2024. But I was encouraged to see that they at least did a modest dividend increase. They keep their streak alive as they work through these tough times right now. But hey, look at it, guys. You could get a starting yield on Archer Daniels Midland at 4.5%. I think they're going to work through these tough times. I don't know how long it's going to take them, but this is an excellent high starting yield, and I think that they're going to keep that dividend streak going years into the future. Hormel starts to worry me a little bit because their payout ratio is higher than ADM's, maybe not quite as comfortable. But a starting yield on Hormel right at about 4% looks pretty good to me. And Genuine Parts Company, another one, 3.4% current day yield with the 4-year average being 2.5%. We've got some value here, you guys. So take your pick, which one's your favorites and all of that. But for me personally, I keep adding to ADM and Pepsi. And then tier 4, age 54 and up, higher starting yield, 5+%, a little bit slower, but hopefully still steady growth rate in that 2 to 4% range. Still nothing here that's a screaming buy. For 54 and older investors especially, I would be more focused on adding to high quality ETFs with a higher dividend yield, which we're going to get to on the next tab here. But that being said, single stocks, I just don't want to take any risks at this point, especially if I'm, 54 or older and I still don't have enough dividend income to feel like I can live comfortably off of that. And I'm working and actively adding to that. I want some safe bets. And while, Realty Income, for example, isn't a terrible buy right now with a yield at 5.86%. I'm probably not going to add any single stocks out of this group until they look a little bit cheaper. Now, the strategy for the week would be as follows. Like I said, half the money for me goes into ETFs. And just some suggestions, some things to think about. Tier 1, the way I'd allocate would be 25% would go into the S&P 500, 15% would go small cap value, 5% into dividend appreciation. VIG is an excellent choice for that. And then I do 5% in international across the board in BYMI for all age tiers. This is my absolute favorite international ETF. It's the only non-US stock holding that I own. Now, tier 2, which I'll be in until November of this year, I've been adding 25% to VIG, 15% into S&P 500, 5 small cap, 5 international. And then when I graduate, so to speak, into tier 3, SCHD, BYM, and DHS are my favorite higher yielding but still dividend growing ETFs. And I would probably be allocating it about like this. SCHD has just been the best of the 3 so far, but BYM and DHS are also super steady. All are excellent picks. All are constructed a bit differently from each other. They're all very unique to each other. But I think they could work really nicely together as a trio. You could certainly just pick one of the 3 and just go hard into that one, but I like to be fairly diverse even amongst my ETF holdings. And then tier 4, I do 15% into SPYD, top 80 highest yielding stocks in the S&P 500, and then alternative investments that I haven't been focusing on up to this point, like high yield bonds, preferred shares, MLPs, covered call ETFs. You can see the allocation strategy there. And because there's nothing in that tier 4 category that we saw a minute ago that looks undervalued, I'd be doubling down into all of the ETFs, staying diversified across the board, getting a lot of high monthly payers. I don't double down into BYMI, so I'd probably throw a little 5%er into Pepsi in that category. And then this is the breakdown of the stocks for each of the tiers. For the young folks, you hit Nike and Nordson hard, grab a little Pepsi in that top 10. And then Hershey and ADM, 50% undervalued in the other tiers. Go ahead and reach up and grab them. Tier 2, Hershey, Target, AWR. Pepsi, a top 10. Nike, Nordson, ADM. And then tier 3, Pepsi, ADM, Hormel, GPC. Hershey, Nike, Nordson. That's how I'd weight it out. And this tier 2 is exactly what I did in my DGI Crab portfolio this week. Let me know what you all think. What are you buying? Are you watching the Super Bowl? And until next time, investors, keep investing.